What if the market's biggest risk isn't a crash, but the fact that it's gotten so massive, so concentrated, and so hooked on a handful of winners that even bad news can't shake it the way it used to? And what if the next big test for investors is hiding in plain sight? AI earnings, a SpaceX-style private market giant, and a stock market that may be turning into the financial version of too big to fail. Stick with me, because today's setup is not just about headlines. It's about where money could keep flowing, where valuations could get exposed, and where investors might be getting way too comfortable. Hey, I'm Vanessa, and I break down market-moving finance stories so you can actually use them, not just watch them fly by. And today's briefing has a very specific vibe. One part AI hype check, one part private market moonshot, and one part, wait, is the whole stock market becoming too important to let fall? That's the kind of combo that can change how you think about risk, timing, and where the next opportunity really is. Let's start with the AI names, because honestly, this is where the tension gets interesting. NASDAQ highlighted 3 phenomenal AI stocks to buy before they report earnings. And the main detail that jumps out is not just the growth story, it's that Microsoft stock has been weak in 2026. Now, that matters a lot more than people think. Why? Because when a giant like Microsoft gets choppy, it doesn't just affect one portfolio. It can reset the tone for the entire AI trade. Investors have been treating AI like the market's favorite storyline for a while now, and earnings season is where storytelling meets reality. That's the moment when the market stops asking, is AI exciting, and starts asking, is AI actually paying off fast enough to justify these prices? And that's the pressure point. If Microsoft has been weak, the market is basically saying, show me. Show me cloud demand. Show me enterprise adoption. Show me whether all that AI spending is creating revenue, not just headlines and CapEx bills. That's why these earnings reports matter beyond the individual stocks. They become a test of whether the AI boom still has room to run, or whether investors are starting to demand cleaner proof. Now, here's the part that makes this especially relevant for regular investors in the US. If AI leaders disappoint, the ripple effect can hit everything from mega-cap indexes to retirement accounts that are way more exposed to those same names than people realize. And if they beat expectations, then you can get another wave of confidence, another leg up in sentiment, and possibly another round of FOMO buying from investors who thought they missed the first move. So the real question is not, are AI stocks hot? We already know the answer to that. The better question is, are these companies still turning hype into numbers? Because in this market, that difference can decide whether a stock gets rewarded like a genius or punished like it was never good enough in the first place. And let me be a little spicy here. The market loves a clean narrative right up until earnings season gets messy. Then suddenly, every investor becomes a detective. Margin trends, guidance, cloud growth, AI monetization, CapEx efficiency, all of it matters. If Microsoft's weakness in 2026 is a warning sign, it may be telling us that the market is no longer willing to pay any price for AI dreams alone. It wants receipts. Which brings us to the next story, and this one is pure market psychology with a side of rocket fuel. SpaceX is now valued at nearly $2 trillion, which is about 34% below its post-IPO high. That sentence alone tells you everything you need to know about how wild private market expectations have become. Nearly $2 trillion for a company that, depending on how you look at it, is still part infrastructure, part aerospace, part internet, part national security adjacent growth machine. That valuation is not just a number. It is a statement. It says investors are not pricing SpaceX like a normal company. They are pricing it like a platform that could dominate multiple future markets at once. And that's why people care. If you're thinking about stocks, mergers and acquisitions, or even the future shape of public markets, SpaceX is one of those companies that forces you to ask a bigger question. What happens when the most exciting growth stories stay private for longer and become so huge that they start to influence the public market anyway? The answer is, they create a weird kind of shadow benchmark. Public investors look at SpaceX and start comparing every aerospace, satellite, defense, and communications name against it. Venture investors look at it and start dreaming bigger. And maybe most importantly, the market starts to get used to the idea that the biggest opportunities don't always show up in your brokerage app first. Now, About that 34% below the post-IPO high detail, that's important because it tells us even elite names can cool off after getting ahead of themselves. People hear SpaceX and think unstoppable, but markets still do what markets do. They reprice expectations, they digest growth, they argue with themselves over what future dominance is really worth today. That is where the investor lesson gets useful. If a company with that kind of story and that kind of valuation can still swing meaningfully from its highs, then you do not want to pretend momentum equals permanence. Whether you're investing in public aerospace names, AI infrastructure, or the broader innovation trade, the message is the same. Even the strongest stories can get expensive, and expensive stories can still disappoint. And there's another angle here that a lot of people miss. SpaceX's valuation is not just about SpaceX. It is a signal about risk appetite across the whole market. When investors are willing to assign nearly $2 trillion to a private company, it says something about how much faith they have in long-duration growth. It also says something about how hungry capital still is for the next giant winner. But here's the twist. That hunger can be dangerous if it turns into blind optimism. Because if investors are chasing the next SpaceX while ignoring valuation discipline, then the market can build a lot of fragile expectations under a very shiny surface. And that's where the third story comes in, because this one is about the surface itself. MarketWatch is asking whether the US stock market is becoming too big to fail, and the idea behind it is that protracted bear markets may be a thing of the past. Now that is a huge claim. Huge. Because if true, it changes how investors think about downturns, recovery, and the role of the market in the economy. The basic argument is pretty straightforward. The US market has grown so large, so central, and so embedded in retirement savings, corporate finance, index investing, and consumer wealth that deep, prolonged bear markets may become harder to sustain. In other words, the market may have become too important to stay down for long. That sounds comforting, right? Maybe a little too comforting. Because if the market has become too big to fail, then that doesn't mean it can't fall. It means the system may be more aggressively built to support it when it does. And as an investor, that changes your playbook in subtle but important ways. You might see faster recoveries. You might see quicker policy reactions. You might see dip buying become even more reflexive. But you may also see bigger distortions. Because when everyone believes the downside is temporary, risk gets priced more casually. That matters for Americans because so much household wealth is tied to stocks now. Retirement accounts, brokerage accounts, index funds, even the psychology of spending and saving can be influenced by what the market is doing. If the market is so large that prolonged bear markets become rarer, people may feel safer taking risk. But safer doesn't mean risk-free. It just means the pain may show up differently. And here's the part I want you to really sit with. A market that is too big to fail can still get very dangerous if investors confuse structural support with guaranteed upside. Just because the market gets rescued faster doesn't mean every stock deserves to be owned. Just because indexes recover doesn't mean weak businesses magically become good businesses. That distinction is everything. So when you put these three stories together, the picture gets really interesting. AI earnings are about proving the narrative. SpaceX is about how far private market ambition can stretch. And the too big to fail market idea is about the system underneath it all, the thing holding up the entire risk-on mindset. That's why this week feels like a test, not just for one company, for the whole market mood. If AI leaders like Microsoft can keep showing real monetization, then the AI trade can stay alive. If SpaceX continues to command breathtaking valuations, then the private market will keep pulling attention and capital toward the frontier. And if the US stock market really is becoming more resilient to long bear phases, then investors may keep getting rewarded for staying invested through volatility instead of trying to time every dip. But if any of those pillars wobble, the market could get a lot more selective, a lot faster. So what should you actually do with this? First, stop treating AI like a single trade. It's not one thing. It's a stack of businesses with different economics, and earnings will separate the real winners from the expensive promises. Second, remember that private valuations can be dazzling and still not be your buy signal. Big numbers do not automatically equal good entry points. Third, if the broader market is becoming more resilient, that is not a reason to get reckless. It is a reason to stay disciplined, because the upside may be supported, but the best returns still go to investors who understand what they own. And let me give you the practical version, in plain English. If you're holding broad index funds, this environment can feel pretty forgiving until it suddenly doesn't. If you're chasing AI names, earnings can either validate your thesis or expose how much future growth is already priced in. And if you're dreaming about the next SpaceX-style winner, remember that the market rewards scale, but it also punishes fantasy. That's the game right now. Big ideas, bigger valuations, and a market structure that keeps getting more important to the entire economy. So the next time you see a headline about AI earnings, a private company valuation, or whether the stock market can ever really stay down, don't just think, interesting. Think, what does this say about the money flow, the risk appetite, and the price investors are willing to pay for the future? Because that's where the real story is. And if you want the honest take from me, Vanessa, this is not the time to be passive about your portfolio. It's the time to pay attention, stay selective, and remember that in a market this big, the smartest edge is still knowing when a story is powerful and when it's just getting expensive.